Welcome to The Explainer. I am so pumped you're here today because we have got something really fascinating lined up. We are taking an incredibly successful, globally recognized giant, Ecolab, and we're putting it straight into the crucible. We're going to break down this stock using the rigorous professional valuation frameworks of some of the greatest investing minds in history, right alongside some strict mathematical models. So let's dive in and put Ecolab through a gauntlet of financial scrutiny to see if that current stock price is actually justified.
We've got a great roadmap today. We'll be moving from qualitative fundamental checks to deep value restrictions, pure math forecasting, and finally, tying it all together into a master synthesis to give you a clear verdict.
Let's kick things off with a snapshot of the business, looking at it directly through the eyes of the Oracle of Omaha himself, Warren Buffett. To set the stage, Ecolab is a massive $78 billion behemoth in water, hygiene, and infection prevention. We're talking operations across more than 170 countries with a workforce of 48,000 people. Right now, as of our data snapshot, it's trading at an anchor price of $274.95 a share. It's an undisputed giant in the specialty chemical sector, for sure. But is it actually a smart investment at that price? Let's see what Warren Buffett would think.
Well, it is pretty amazing to see how effortlessly Ecolab clears Buffett's qualitative hurdles. I mean, they literally help protect a quarter of the world's power generation and a third of its food production. Plus, they're expanding into this super lucrative AI data center cooling space. That is a massive economic mode. Consistent earnings? Check. 39 straight years with absolutely no dividend decreases. They've got a solid 17.3% return on equity, and with about $6.9 billion in long-term debt against $10 billion in equity, their leverage is completely manageable.
You also know Buffett loves honest, highly capable management, right? Well, CEO Christoph Beck's guidance is pointing to a really robust, profitable operation. They're targeting 5 to 7% organic revenue growth and a very consistent 12 to 15% EPS growth. Management is confident, and honestly, the historical data totally backs them up. But here's the ultimate Buffett test: owner earnings. Essentially, the actual cash the business generates that can go back into shareholders' pockets. Ecolab targets an absolutely massive 90 to 100% free cash flow conversion of net income. That is a high-quality earnings profile Buffett would absolutely drool over. But, and there is a but here, he'd demand a margin of safety. Given their growth, a strict Buffett investor would probably want a buy price closer to $200 to make sure they aren't overpaying.
Okay, let's switch gears and see how this looks when we apply the growth-focused Peter Lynch lens and the deeply conservative Benjamin Graham framework. So, Peter Lynch categorizes companies strictly by their growth narratives. He'd likely see Ecolab as a rock-solid stalwart that's suddenly getting this massive adrenaline shot, a fast grower injection, from its new AI data center cooling targets, which they want to hit $4 billion by 2030. Benjamin Graham, on the other hand, he completely ignores the narrative. He's looking at the market strictly as a defensive investor, relying purely on hard, trailing fundamental metrics.
Check out this Lynch-Peg ratio right here, 2.38. Now, assuming institutional ownership is high, which it almost always is for a $78 billion blue chip, Lynch would be treading very carefully here. Just doing the math, with a PE multiple around 32 and projected earnings growth of 13.5%, that 2.38 peg suggests the stock is, well, pretty pricey. Lynch really likes a peg closer to 1.0. So for him, we're probably looking at a hold rather than a pound-the-table buy.
And this really highlights just how uncompromising Benjamin Graham's checklist is. Remember, this is the father of value investing. Now, Ecolab passes his test for adequate size, financial condition, earning stability, and dividend record without breaking a sweat. But those valuation multiples? Total fail. Graham wants a PE below 15 and a price-to-book below 1.5. Ecolab is sitting at a 32 PE and a price-to-book of almost 7.7. The market is pricing in a massive, massive premium here.
If we want to calculate Graham's exact buy price, we have to use his famous intrinsic value formula. You take earnings per share, multiply it by book value per share, multiply that by his baseline constant of 22.5, and take the square root. Now, to be fair, this formula is notoriously unforgiving to modern, asset-light, high-growth companies.
Using an annualized EPS of $6.08 and a calculated book value of $35.47, Graham's model spits out a tremendously harsh, almost comical $69.66 intrinsic value. If you wanted a 33% margin of safety on that, Graham wouldn't pay a dime over $46. I mean, let that sink in for a second. He literally wouldn't touch this stock today unless there was a catastrophic market crash.
All right, let's step away from the gurus for a minute and dive into pure mathematics with a discounted cash flow analysis.
The mechanics here are super straightforward. Step 1, we project the cash the business will generate over the next 5 years. Step 2, we calculate the terminal value, basically what the business is worth into perpetuity after those 5 years. And step 3, we discount all of that future money back to its present value today.
For our assumptions, we're assigning a standard 9% discount rate, which is pretty typical for a stable, large-cap chemical company. For growth, we'll use management's optimistic 13.5% cash flow growth for the next 5 years and a 2.5% terminal growth rate to roughly mirror global GDP.
Now, you never just want to rely on a single number in financial modeling. You need to look at a range. If we run a sensitivity table, you can see how tweaking the discount rate and terminal growth changes everything. If we get super optimistic, say an 8% discount rate and 3% terminal growth, we get a value of $198. But if we're more conservative, at 10% and 2%, it plunges to $105.
Our base case DCF, right in the middle, gives us a fair value per share of roughly $142. Keep in mind, our anchor price right now is almost $275. So according to future cash flow math, the stock is currently trading at nearly double its intrinsic value.
Let's actually test that massive discrepancy by bringing in a couple of additional valuation models. We're going to look at the dividend discount model, which values a stock purely on the present value of its future dividend payouts. Then we'll completely flip the math backward with a reverse DCF to see exactly what kind of growth the market is currently pricing in to justify that $275 price tag. Assuming a 10% required rate of return and an 8% historical dividend growth rate, the dividend discount model gives us $141.50. What's wild is how perfectly that aligns with our standard DCF base case of $142. But even more telling, the reverse DCF shows that for Ecolab to actually justify its current price, it would need an absolutely unrealistic 20% sustained cash flow growth over the next 5 years. Remember, management is only promising 12 to 15%, and that is already aggressive. Okay, let's pull all of this data together and get to our final verdict.
When we line up every single framework on our master scorecard, the picture becomes crystal clear. Current price, around $275. Buffett might stretch to $200 for the sheer quality. Lynch sees a pricey PEG ratio. Graham sees a wildly inflated asset at $69. And our pure math models both land right in the low 140s. Literally every expert lens we have says this stock is trading at a steep premium.
Now let me be crystal clear here. Ecolab is an unbelievable business. That moat in water and infection prevention, bulletproof. The AI cooling business, a brilliant growth engine. And that 90 to 100% free cash flow conversion is just best in class. But as analysts, we have to separate a great company from a great stock price. The biggest risk here is the valuation multiple. At a 32 PE, it's priced for absolute perfection, making it highly vulnerable to any macro slowdowns. So, blending Buffett, Lynch, Graham, and our cash flow models, my final recommendation here is a hold if you already own it, but definitely not a buy at these levels. I'm going to leave you with this one final thought. Truly great companies almost never trade at cheap prices. The market clearly sees Ecolab's undeniable quality and is charging a massive premium for it. So, as you build out your own investment frameworks, you have to ask yourself, what is your personal margin of safety? And at what price point does the discipline of value investing finally outweigh the fear of missing out? Thanks so much for joining me for this explainer today. Keep learning, and I'll catch you in the next one.